A minus 5k loss can become minus 19k without the market needing to do much more than keep moving in the same direction. The real danger is not the first mistake, it is trying to rescue it with borrowed money and worse decisions. That pattern is more common than people admit. A position starts going against you. You do not want to realize the loss, so you add capital. Maybe you borrow another 5k and tell yourself it is just a bridge back to break even. But if the market keeps moving against you, the problem does not shrink. It compounds. The account is no longer dealing with one bad entry. It is now dealing with pressure, leverage, and the need to be right. That is why losses are rarely just financial. The first drawdown is visible on the screen. The second loss shows up in behavior. Once the position is under stress, the investor is no longer only asking whether the original thesis is valid. He is also asking how quickly he can get back to zero. That question sounds practical. Usually it is destructive. Averaging down, adding to losers, and borrowing to fund recovery can feel rational in the moment because they create the illusion of control. But the market does not care that the money was borrowed. It does not care that you meant it as temporary capital. If the position is structurally wrong, more leverage usually makes the damage worse, not better. This is where conviction gets confused with stubbornness. Real conviction is based on evidence, scenario analysis, and predefined risk. Stubbornness is what remains after the evidence changes but the ego does not. And the market is very effective at exposing that difference. There are really two pressures here. First is the unrealized loss itself. Second is the pressure to prove discipline to yourself, or to other people. Once borrowed money enters the picture, shame and obligation join the trade. Now the downside is not just a loss. It is a financial commitment that can narrow judgment even further. The right lesson is not that you can never add to weakness. The lesson is that any action taken into weakness must be pre-planned, not improvised under stress. Professional investors think in terms of thesis risk, liquidity risk, and ego risk. If survival requires new capital after the fact, the original position was probably too large or too poorly structured. So before entering a trade, ask a few simple questions. What exactly invalidates the thesis? How much loss can I absorb without changing my behavior? Is adding to weakness part of the strategy, or is it a violation of the strategy? And most importantly, if this idea is wrong, how do I get out without turning it into a crisis? That last question matters more than most people think. Position sizing is not a secondary issue. It is the main defense. A small, well-structured loss preserves optionality. A large, financed loss destroys it. Once optionality is gone, you are no longer managing a portfolio. You are managing survival. Discipline, in practice, is the willingness to execute the prior decision when it becomes uncomfortable. In markets, that often means taking the loss early enough that it stays a business decision, not a life event. That is especially important when leverage or borrowed money is involved, because the emotional and financial recovery path becomes much narrower. So the real question is not whether you are willing to average down. The real question is whether you built the trade so that a wrong thesis can be exited cleanly. If you did not, then the issue is not just the trade. It is the structure around the trade. Markets do not merely punish bad ideas. They punish the refusal to contain them. The best defense is modest size, clear rules, and the humility to cut the loss before the account, and the mind, become trapped.